So, what I want to talk about is your income is the asset. Why protection comes before wealth building. Okay. And I want you to think about that for a moment. There are certain things when you're dealing with finances, you are building a foundation, and there are certain things that you do before others. So, for example, we want to build an emergency fund before we go out here and start trading in the stock market. That's just a foundational thing that you have to do. You have to build your emergency fund. You need to build your buffer fund before you build your emergency fund. So these are all the things that we have discussed and talked about. Tonight, we're going to talk about insurance. And insurance, believe it or not, insurance is one of those foundational things to build before you start really getting heavy and creating wealth. And so we have to protect ourselves. Your income is the asset. Now, there's many different types of insurances. We're going to talk about life insurance tonight, but there's many types of insurances out there that you want to use. All right, so the first thing I want to do is I want to go and tell you about this story here. Luke 12:16 through 21. I didn't even have the time to pull that up here, so we're going to pull it up. We're going to pull it up right now live here, okay? Luke 16. I think it was, what is it? Was it 21? Hold on. Let me go back. Let me go back and take a look. Luke 16, Luke 12, 16 through 21. All right. Luke 12, 16 through 21. Luke 12, 16 through 21. There's something really good that I have to tell you about with this particular story. And so what you guys are going to see is this is a parable about a rich fool, a rich fool. Okay. That's what they call it, a rich fool. And so, and he told them this parable: the ground of a certain rich man yielded an abundant harvest. He thought to himself, what shall I do? I have no place to store my crops. Then he said, this is what I'll do. I'll tear down my barns and build bigger ones, and there I will store my surplus grain. And I'll say to myself, you have plenty of grain laid up for many years. Take life easy, eat, drink, and be merry. But God said to him, you fool, this very night your life will be demanded from you. Then who will get what you have prepared for yourself? This is how it will be with whoever stores up things for themselves, but is not rich towards God. And so I want to talk about a couple of things that are here in this scripture. We can see that this rich man had a abundant harvest. So he is a profitable man. He is someone who knows how to make money. He knows how to get his money to make money for him. And he had so much money that he didn't have any place to store this money. And so he began to devise a plan. And that plan was, I'm going to tear down the barns that I've got. I'm going to build some bigger barns, and then I'm going to have a surplus. And then once I get that done, man, I'm on easy street. I can take it light at this point. I can rest. I can take life a little easy. I can just kind of coast through life. I can be extremely happy. But then God came to him and said, you are a fool because your life is going to be demanded of you this night. And then who will get what you have prepared for yourself? Who? So maybe the man probably didn't have a will, because if God is saying who's going to get this? That means the man ain't have no will. He ain't had no insurance policy. He ain't had none of that. But he was a wealthy man. He was a man who knew how to save. He was a man who knew how to plan. And all of those things by themselves are good things. But Obviously, he put all of his emphasis on his riches and not enough on God. Now, it took me a long time to learn what this meant. My grandmother, when I was a kid growing up in South Carolina, she would be talking and she would always say this: yeah, we're going to go do blah, blah, blah. And I'm going to do such and such, Lord willing. And she would always say, Lord willing. I'm going to do this, Lord willing. I'm going to do that, Lord willing. And I don't know if you've ever heard old folks say that, but man, when I was a kid, I'm like, what's she talking about? Lord willing, Lord willing. Like, God ain't gonna let you do that? And I just didn't know this verse here, didn't know anything. And so when I when I came across this scripture, it made me really think about my grandmother, and it made me really think about all the times that she would talk about her plans, and she would always say at the end of that conversation, she would always say, Lord willing. And so, what I want you to understand is that on the Sunday night call, of course, we talk about building wealth and creating wealth and, doing all of these things so that the time that comes when we can retire, we've got money to do the things that we need to do. We got to be careful on that because we need to add the emphasis of Lord willing. So if you don't mind, I'd like you to type in the chat, Lord willing. All right? Just type in the chat, Lord willing. Okay? Because it's an important thing for you to acknowledge. It's an important thing for you to say is that you have to acknowledge the master because you can have all the things on earth and your life be taken away from you. Okay? So, a man's life does not consist in the abundance of his possessions. So, June, what are you saying? Are you saying that I shouldn't plan? Are you saying that I shouldn't try to become abundant? Are you saying that I shouldn't save? No, I'm not saying any of those things. All of those things the man did, and he did very well. He mastered his money. He did that very well. But what I'm saying is that you cannot take assumption on anything. And your insurance, in this case, your primary insurance is Jesus the Christ. That's your primary insurance, right? You better make sure that that's paid in full. He paid a price for us, but there is a price that you have to pay. Take up your cross. There is a price that you have to pay. Now, I'm going to go some of these things, and I got some pastors on the call here tonight, and they're going to eat this up because there's. Now I'm gonna stay on the financial side, but this also has a spiritual side to it as well. All right. So now the story isn't about saving. I want you to save. I want you to plan, and I want you to grow. But what I don't want you to do is have a false security. I don't want you to think that everything's going to be all right. I don't want you to think that. I want you to plan for hard times. I want you to plan for things not going the way you thought they were going to go. The rich fool's era wasn't ambition, he had plenty of that. It was his trusting of abundance over preparation. Did he prepare? Did he spend time in God's face? Did he spend time in the Word? Because that was the insurance policy that he needed. Oh, some preacher back there gonna tear that one up. Quest out there, he chomping at the bit. It was the preparation of the next life. Did he prepare properly for the afterlife? Now, the man had a plan. He had a plan for more income. He had a plan for more storage. He had a plan for more time. He had already planned all these things out. And ladies and gentlemen, on the Sunday night call, we teach you all of these things. I teach you how to plan for more income. I teach you how to plan for storage. I teach you how to plan for more time. But I got to also teach you how to plan for risk. Now, I'm talking about finances here tonight, but there's also a spiritual side here, and the spiritual side is even stronger than the financial piece that I'm going to talk about tonight. But if you're a pastor out there, you're a preacher, you can take this, man. You can take this and go with this. You can run with this. All right. But we're gonna stay on the financial side because that's my area. Okay. So this man had wealth, but he didn't have protection. He had accumulated a lot of wealth, but did not protect it. And he left his family exposed. He said, I'm going to build bigger barns to store some stuff, but he didn't have any protection. And in his case, he didn't have the protection with a relationship with Christ. I'm going to talk about not having a protection for life insurance. See, you can have all the wealth in the world, but if you don't protect what you have grown, you can lose it at a blink of an eye. And so we're going to talk about that here tonight. Okay. Now, here's what the Bible says further on about being prepared. Protection. Proverbs 27:12 says, the prudent seek danger and take refuge. They see danger, they don't seek it. They see danger and take refuge. That means that, hey, and it goes on about what a fool does. But we ain't got no fools on the call tonight, so I'm not going to expand the verse. I'm going to talk about the prudent, the wise. They see danger. They understand that every day ain't going to be sunshine. And they take refuge. They understand where to go get protection, where to go stay safe. Now, to prove to you that everything ain't going to always work out the way that we think it should work out, Ecclesiastes 11:2 tells us to divide your portion to seven or even to eight, for you do not know what misfortune may occur. So God is telling us that there is going to be some troubling times. There is going to be some mishaps. There's nothing that you and I can do about that. We don't know when or what is going to be, but we can prepare for it. We can definitely prepare for it. And so don't be like the rich fool. Don't ignore the risk. The issue was not saving. The issue is that he didn't have any insurance. And like I said, in that case, in that verse, he didn't have a relationship with God because he put his money over the relationship with God. And we don't never want to do that. That's why we always want to say we're going to plan out, but at the end of our plans, Lord willing, he give me another day. Lord willing, he'll allow me to see next year this time. Lord willing, right? Keep that in your pocket. Lord willing. You see, because your savings will fill the bucket, but the bucket can be destroyed. And what insurance will do, insurance will help you rebuild the well. Let me say that again. You can have a whole bunch of money in the bucket, and you can lose the bucket. But your insurance will help you rebuild the well that allows you to have the wealth that you had in the first place. So we want to talk about this insurance. Okay. Insurance equals protection. It is a system that protects you financially when life doesn't go as planned. Insurance is not a product, it's a promise. It's a promise that when it's kept, it matters the most. Because when we leave here, we're hoping that the promise that we paid for actually takes care of itself, right? I'm hoping that the day that I close my eyes on this side of the earth, I'm hoping that those that I love that are still here, I'm hoping that the insurance that I purchased, the promise that the insurance company has given me, I'm hoping that they will actually execute so that the loved ones that I left behind have something available. So that insurance is a promise. It is a promise, right? Man, we can go spiritually on this. God left us a promise. There was a promise. Oh man, I'm gonna let the preachers preach on that. Now, what is insurance? What is it for? It is for the transfer of risk. You don't eliminate the risk, you move it to someone else who is equipped to carry it. Oh, Oh my God. Ain't this great? Because we coming up on Resurrection Sunday. Man, this I should have saved this for next Sunday. We don't eliminate the risk, but we move it to someone who is more equipped to carry the risk. So you have unpredictable risk. You don't know when you're going to go. You don't know what's going to happen. So what do? You pay a small predictable premium. You pay a small price. And that small price goes to an insurance company. And that insurance company takes on the larger risk. They carry the risk. You got a small risk, which is the premium, but the insurance company has a larger risk, and you avoid unpredictable loss. I hope this is clear. I'll try to make this as clear and easy as possible to understand. Let's move on. You can't control life. Not the time or the hour. You don't know what accidents are going to happen. You don't know what your health is what's going to happen with your health. You can't control any of those things. But what you can control is preparation. Can I get some life insurance? Can I get some health insurance? Can I get some disability insurance? See, all of these things are protection. Wisdom is not about predicting the storm. You're not a weatherman, but it is building the shelter before the storm arrives. That's what wisdom is. I don't know when it's going to rain, but I do know it's going to rain. And so I've got to begin to build protection for when that day comes. So everybody understand that. I hope everybody is getting this. Now, some of you may say, I don't know about that life insurance and this and that. Well, you already believe in insurance. You already believe in it. You got car insurance. You got homeowners insurance. You even got insurance on that cell phone. You got that iPhone. You got some insurance on that iPhone just in case you drop it. So you will protect a depreciating asset like a car. A home could be an appreciating asset. Surely the phone is a depreciating asset. You will put insurance on a depreciating asset, but won't put insurance on your life. And what is your life? What are you protecting? You're protecting your income, your ability to generate income. That's what life insurance is for. It is to protect your income. Remember at the beginning of this, I said your income is an asset. Okay. So you're willing to go ahead and protect a $1,000 iPhone. I think they're getting a little bit more expensive than $1,000 these days, but you're willing to protect a $1,000 iPhone, but you won't protect $1 million life, your life for your family. All right. You won't do that, but you should. But you should. Okay. You should definitely do those types of things. All right. Miss Victoria, it is that time. So you can go do what you need to do. It's that time. All right. So what are you protecting? All right. Now, your income is the asset. I kind of already let that cat out of the bag. Your income is the asset. You got to protect the asset. So your life produces the income that your family depends on. This is what must be protected. You're not just a person. This is good right here. You're not just a person. You are an economic engine for everyone who loves you. You are an economic engine for your spouse. You are an economic engine for your children. That those people are the ones that you are purchasing life insurance for. Now, if you single, you ain't got nobody, you ain't got no kids, and it's just you just need enough to put you in the ground. You need enough life insurance to put you in the ground because nobody is depending on your income. But when you get to that point where you have some responsibilities and some people are depending on you, then life insurance becomes more important. And I'm not even saying that if you're single that you shouldn't have it, because at some point you're probably gonna get married and you probably need to have that life insurance. But what I'm saying is that if you are a single person, you don't need what you need when you're married and somebody's dependent on you. Well, June, I'm single, I got a house, I got a car. Who cares? If you die and you still owe, it don't matter, right? Because nobody's dependent on your income. Nobody was dependent on that. So your income is the asset. All right. Now, here's what you got to ask yourself this question. What happens if you're gone? Men, what happens if something happens to you tomorrow? What happens to your wife? What happens to your children? Will the family have to start all over financially? That's the question. Will they have to start over financially? You done scraped and struggled. You built something. You passed away. The income that you brought in is no longer able to sustain. See, just because you die, don't mean that Visa and MasterCard and Ford Motor Company ain't gonna send a bill next month. Yeah, you dead, but they gonna send the bill. Your mortgage company, Wells Fargo, you died, but Wells Fargo gonna send the bill to your wife the next month. See, nothing stops just because you died. Is your family going to have to start all over financially? Are they going to have to struggle? Are they going to have to downsize their lifestyle because you did not prepare yourself? These are the things that you need to know. You see, the question isn't if something happens, it's whether your family is going to be ready when it happens. There aren't too many people that have escaped death. There's a few. We talked about a few people that have escaped death, right? But all are gonna see that. We all gonna see that side. We might as well go ahead and say that we all gonna see that, right? Even Jesus Christ died, right? He was resurrected, but even he died. And so we know that that day is coming for each and every one of us. So it's not whether it's gonna happen, it's when it happens, will my family be ready? And if you don't like having those type of conversations, you need to get your head out of the sand because the day is coming. Every person on this call, your day is coming. There's a date and time for you. There's a date and time for me. So if I know that as a wise, prudent man, I have to take care of my family. I need to go out and do the things so that when I'm no longer here, my presence is still here. The asset that I am creating is still here for those that need it. All right? Hard conversation, but it's a true conversation. Now, I want to give you guys something. Here's Joe. Joe makes about $70,000 a year. Now we're gonna do some Q&A here with this. So get ready to type. So Joe has a $70,000 a year income. He lives in a middle class neighborhood. He got a $200,000 house. Nothing fancy. It's a basic house, as you can see. Joe's got about $40,000 of debt. That includes maybe two cars and some credit card debt, whatever. He's got a wife and two kids, and his wife stays at home with the kids. Now, Joe is hardworking. He's loving. I put here underinsured, but we're going to say that Joe has a $1 million life insurance policy. So Joe really ain't underinsured because when you talk to a real estate, when you talk to an insurance agent, they tell you that you need 10 to 12 times your salary. Okay. So we're going to say that Joe got more than 12 times his salary. All right. So he has a $1 million life insurance policy. One day, Joe goes off to work, but he doesn't make it back home. Joe dies. He dies unexpectedly. So, what happens next? Like I told you, the bill's still going to come, but Joe's employer might send you and your family, he might send Joe's family some flowers. Maybe. The employer might send some flowers, but they ain't sending another check. They're going to send Joe's last check. That's the last time that he worked. They're going to send him the last check. They might send you a flower and a card. What you do? What you gonna do now? So here's what I want to do. His wife is sitting there. She put Joe in the ground, had a nice funeral, and now she's at home without a husband, without someone, her breadwinner. She's struggling on all different levels. She's struggling, but she goes and looks in the mailbox. Mailbox. Joe had an insurance policy. They sent her a check for $1 million. What should the wife do? She got a lump sum. She ain't got to pay no taxes on it because it's an insurance policy. What should she do? I want you to type in the chat. What would you do? I'm going to look at the chat here real quick. What should she do? So somebody said, pay off some debt. Okay, cool, cool, cool. Delivering a death claim to my client was life shifting. Robert says, pay off all debt, pay off house. Okay. So now here's what I want to understand. So she got a $200,000 house. She got $40,000 worth of debt. That's $240,000. That means that she still got some money left over. She got $1 million. So what's she gonna do? What's she gonna do with the $760,000 that's left? Right? Somebody says invest the rest of it. Pay off debt, put back money for savings. Pay off all debt. Invest. Invest in what? Invest in what? Come on, y'all. Somebody says pay off debt, invest, and replace income with another career. She's a stay-at-home mom. What career she got? Somebody said the stock market. She can live at least 10 and a half years with what he earned. Praise God. Make money, make money, make money. Get in June's class. Okay. Buy some life insurance. Now, that's a good one. I that's a good one. I would definitely go get some life insurance. Now, mama needs some life insurance for the kids because she got some kids. But that's still a that she can take care of that life insurance policy. Miss Gavin says S&P 500. Invest in income producing assets. See, y'all talking general stuff. You talking I'm looking at what you paste in here. That means that you don't know. I want you to be honest with yourself. I ain't for sure. I got $750,000. I don't know what to do with it. That's what most people are. Most people ain't coming to the June Collier class. They ain't coming to the Sunday night call. She was a stay-at-home mom. Do you think she know what to do? She ain't got a clue. She has no clue. Now, let me help you break it down. Here's what I think is good. Somebody says connect with a financial advisor. That don't mean nothing. They crooks too. Not all of them. But she don't know nothing about finances. How she don't know she gonna get with a crook? This is real. This is real information here. Okay. And so here's what I would tell you. I would tell you for this lady, because there is no right or wrong answer. A lot of you got some information here. There's no right or wrong answer. But this lady here, if she's not financially literate, which most people aren't. She may decide to go to a financial advisor. And just because you go to a financial advisor and he sees you got $760,000, that's a payday for him. I'm just going to be honest with you guys. Anytime you go to somebody who is selling something to you, you better have some knowledge. I don't care if it's a financial advisor. I don't care if it's a company that you saw on television. I don't care if it's your insurance agent. You better have some financial literacy information for yourself. Because if it's a financial advisor, they might say, you know what, $760,000. I'm gonna put this person in something I can get a maybe a 5%, 10% kickback on. They looking at their pockets too. And ain't nothing wrong with that. Understand this. Being a financial advisor, being a insurance agent, there's nothing wrong with that. But what's wrong is when you go to a financial advisor or an insurance agent and you know zero, you know nothing, and you have to depend on what they tell you. That's a bad place to be. That's a horrible place to be. So let's talk about it. She paid off the house. All right, cool. I'm okay with that. I'm okay with that. She paid off the debt. I'm cool with that. Now she ain't got to worry about a house payment. She ain't got to worry about debt payments. But she still got expenses. You see, even though the house is paid for, you still got taxes. You still got insurance on the house. You got insurance on the cars. You still got to eat. You got lights. You got all of those things. She got to replace her husband's income. How much was her husband's income? Somebody type in the chat. How much was her husband's income? Do you remember? Type in the chat. How much? $70,000. How much does she have left over after she paid the house off and the bills? She got $760,000. How much does she need to replace her husband's income? What kind of investment vehicle, what percentage does she need to replace her husband's income? I need y'all to follow me. I'm going somewhere heavy. I'm going somewhere heavy. She needs $70,000 a year. She got $760,000. How much does she need to replace her husband's income? Come on, somebody. Ah, Kim says about roughly 10%. So she needs somewhere between 9 to 10%. How do we figure that out? How do we figure that out, y'all? We figure that out because if we take a look at $760,000, if she gets a 10% return every year, that would give her $76,000 a year. Her husband had a $70,000 job. Now, here's the reality. She really don't need $70,000 a year because she no longer has debt. She no longer has a house payment and all of that. So she could probably get away with about 8%. So if I pull out my calculator, that's what we're going to do. We're going to pull out the calculator because, see, I need you guys to understand what the thought process is before she go to some financial advisor or anything else like that. So we got our calculator here. She got $760,000. And let's just say that she get 9%. She can get 9. Not, we ain't gonna do 9%. I'm gonna do 8%. I'm gonna do 8% in the market. That would give her $60,800 a year. She probably can live off of that. You know why? Because she ain't got no house payment. The cars are paid for. She got no credit card debt. If she can maintain her current lifestyle, she'll be okay for the rest of her life. You see, we didn't eat up the 760. We just gonna live off of what the 760 produces. You're not going to eat the seed. You're going to eat the harvest. But we never going to touch the seed. We ain't never touching the $760,000. Do you guys understand? We ain't never going to touch that. Okay? Now, she's got to find a vehicle that's going to give her 8% or better. That's what she needs. She needs a vehicle that's going to give her 8% or better. So before she go anywhere, she already know what her needs are. I ain't going to no financial advisor until I figure out what my needs are. So I need about 8%. If I get 9%, if I get 9%, 760,000, hold on. Let's this is what she need to be doing. She need to be on the calculator. I know she got a napkin and she crying, but she need to get on the calculator too. So we got, if I go 9%, that's 68,000. So she need between 9 to 10%. 10% would give her $76,000, which is $6,000 more than what her husband brought in. Okay. So she now knows what I need to be able to replace my husband's income. So the key here is I got to know what percentage I need to make on this money that's left over to replace his income. So now, if you tell me to go get an annuity or go get this and get that, because that's what they're going to tell you, you know you're in the wrong place. Now, we know because you guys have gone through my class, we know that the S&P 500 has averaged about 12% a year. That does not mean that every year you're going to get 12%. It's just averaged 12% since existence. So let's go take a look at that. Let's go take a look and go to Google here. And what we're going to say, what has the S&P 500 averaged? You know, we can do over the last 100 years if you want. We'll just do over the last 100 years. Over the last 100 years, the S&P has averaged 10 to 10.5% over the last 10 years. Okay. Now, if I want to see what it's done over the last, maybe I'm not concerned about 10 years. Let's say over the last 30 years. If I look at the last 30 years, again, we're looking at 10 to 10.5%. So she needs 9.5. If she gets 10%, she's gonna do better than what her husband did. So maybe one of the things that she's going to do is she's going to look at getting her money into an S&P 500 index. Maybe. But at least now she knows where to direct her attention. I need between 8 to 10% return to be okay. Now, let me tell you what most people do. Because y'all gave me the pretty answer. Y'all gave me the pretty answer. Y'all were real pretty with your answer. I'm gonna paint the real. I'm gonna paint the real scenario. My husband died. We living in this $200,000 house in a regular neighborhood, and we just been getting by. He was making 70,000, $75,000 a year. That ain't a whole lot of money. I mean, they not broke because he was good with his money, but they not living lavish or nothing like that. And she ain't never seen a check with more than probably, five figures on it, right? She probably ain't never even seen a six-figure check in her life. She been living a mediocre life. She's a stay-at-home mom. What's she gonna really do? Y'all tell me what she gonna do for real. Y'all tell me what she gonna do for real. I don't want that. I want that them fake answers. What's she getting ready to do for real? And I'm not saying that she's mediocre. I'm saying that, and when I say mediocre, this has nothing to do with her, has nothing to do with her gender or anything like that. What I'm saying is that she's living a middle class life and she's lived a middle class life her whole life. Okay? Boom. Somebody said move out and buy a bigger house. You absolutely right. What else she getting ready to do? She about to take a trip, girls trip, right? Because I need to get a girls trip because I'm emotionally distraught. Quest says she's gonna move emotionally, right? She gonna find another tenderoni. y'all, y'all some fools out there. Okay. So when people have never had that amount of money, I need you to understand she got a check for $1 million. She ain't never seen that. She ain't never had that money before. And the husband just left her a check, no instructions. He thought he did a good job. I got a $1 million life insurance policy. I never talked to her about how to handle this money when she got it. We never had the conversation. We never went to any finance classes. We never talked about what we're going to do if one of us should pass away. We never talked about any of that. Somebody says women are smart, though. Let me tell you guys something. I knew a person when I was coming up who had a parent pass away. Both him and the surviving, oh man, I didn't mean to say that. Let me leave that story alone because somebody might be on here and they might be able to track. Here's what I'm going to say is that people who have never had that level of money, they have a very strong chance of messing it up. I'm just going to say that. They got a very strong chance of messing it up. Him and his mama bought a brand new car. There's some other things that happened. Again, I'm gonna keep it brief because I don't know who on my call. But what I do know is about 5 years later, all that money was gone. It was gone in about 5 years. And that's not saying anything bad about them. Because what I want you to understand is that most people ain't never had $1 million. And if you get $1 million in your hands and you ain't never had it before, you're gonna have to be extra careful because you're gonna make some mistakes. And maybe you think you're making a good choice. You go and you give your money to your financial advisor, and you find that your financial advisor ain't worth a toot. Everybody got the title financial advisor, don't know what they're doing. Everybody got the title of insurance agent, don't know what they're doing. They are salespeople. And I know I got insurance agents on the call. I ain't. We need them. We need an insurance agent, but you need to have knowledge before you go to one. Because if you don't, they gonna slick you like a can of oil. All right, I'm gonna get off my horse on this one, but I want you to understand that just because you got a life insurance policy on your spouse, on your family, don't sit back and rest and put your hands behind your head. You better make sure your spouse knows what to do with that money when the time comes. Or you better make sure that instead of your spouse being the beneficiary, you better make sure that your trust is the beneficiary and you put instructions in your trust so that nobody in your family screws it up. That's a real man right there or a real woman that has the trust, and the trust dictates what happens to the insurance policy. That's another day, another topic. Okay. Now, Let's talk about insurance because all insurance is not the same. You got term, you got whole life, you got variable, you even have an annuity. An annuity is an insurance. Sometimes they try to sell it like it's a investment, but an annuity is insurance. And then you got the IUL. Each product serves a purpose. The right choice depends on your season of life. All right. I ain't saying nothing bad about none of these. So I'm gonna say that up front. I ain't saying nothing bad about none of these. We're gonna talk about the IUL because the way that the IUL is being positioned on the internet, every little Joe Blow on TikTok, on Instagram, and on this and on that, got all these things to say about IULs, and they don't know what they're talking about. Is an IUL good for the right person? For the right person. Let's talk. Now, the first thing I want to talk about is insurance in general, life insurance. If you got Mass Mutual in John Hancock and you got a $1 million, I'm gonna just make it simple. You got a $1 million term life insurance policy. What's the difference between John Hancock and Mass Mutual when we just look at the basics, the basic fundamentals? What's the difference? If both of them are $1 million life insurance policies, should you pass away, they have the same death benefit. What's the difference? Okay. Now, somebody might say, well, John Hancock, man, they're gonna pay you fast. You die today, they writing you a check tomorrow. All insurance people gonna tell you why their insurance company is better, but you don't know. You know why you don't know? Because you ain't done no research. You just going based off of you like the insurance guy. The insurance guy is your cousin. The insurance guy is the guy at your church. The insurance guy is the guy that you've known for 10 years, and so they ain't gonna steer you wrong. You don't know. But what I realized is let's look at the product. What's the product? The product is $1 million. Now, if one insurance company send you crisp 100 $1 million bills, and the other one send you $1 million in crumpled up bills, guess what? You're gonna spend both of them. They're the same. One is crumpled up, the other one is crisp. It don't matter. So now when I understand what I'm buying, so if I was buying a Toyota Tercel, or I don't know, I just said Toyota Tercel. I'm buying a brand new 2026 Toyota Tercel LX model. I go to one dealership, they got the 2026 Toyota Tercel XL model, and I go to the other dealership. They got the same car, same color, same model. Everything's the same. How am I going to make my choice? In the chat, how do I make my choice if both products are the same? And nobody's saying nothing. No, I ain't looking at the interest, the price. Thank you, Miss Avant. If both, okay, somebody say, yeah, y'all, I'm hardcore tonight. Somebody said let the Holy Spirit lead you. So, okay, if car company A is selling the Toyota Tercel for 25,000 and car company B is selling the Toyota for 35,000. Same car. One 25,000, one 35,000. Both of them brand new. Who you buying from? I mean, I'm spiritual and everything, and I want to talk to. I do want to pray and make sure that the Toyota Tercel is the car that I need. And Lord, do I need to buy a brand new car and all of that stuff right now? But God gives me common sense as well. When He tells me, okay, it's time for you to buy the car, and I go and I look to see what car am I getting if it's the same thing. And so everybody got it now. I'm looking at If I'm looking at a 2026 Toyota Tercel and they both got the same features, I'm looking at where's the cheapest price. Where because it's the same product. So now when we look at insurance, it's a little bit more difficult to do with insurance what I just explained with the Toyota Tercel. But I want you to think that way. I want you to think that I got $1 million. I'm buying a $1 million promise. Okay. And it don't matter if one insurance company gives you a crumpled up $1 million and the other one gives you a crisp $1 million. They still $1 million. So now I need to make a decision based on what my insurance company that I'm dealing with. But the first thing I got to do is I got to make sure that I'm comparing apples to apples. And this is where the insurance company gets you. You can buy a term life insurance policy and still not have apples to apples. They got all kind of other stuff that they got tied up in it. They got all kind of stuff. You think they create these products for you and add all this confusion for nothing? Do you think they just want to give you a basic, hey, you die, you get $1 million if you die within this time period? They ain't gonna do that. They want to add all these little frills and all this stuff and this terminology to confuse you. All right. So, not all policies are created equal. You have to understand the structure so that you avoid buying the wrong protection. So, let's talk about that. There are some things that you can look at. You can look at the strength of the insurance company. Are they A rated, A plus rated, A plus plus rated? Are they B rated? Where can I go? There's companies that will give you the rating of the insurance company. AM Best, Essence Standard and Poor's, Moody's, Fitch. These are organizations that can give you ratings on the insurance company. Now, if you got insurance on this call, did you check the ratings before you bought the insurance? I know I didn't. No, and I'm teaching the class. I didn't do it. I had a buddy sold me some insurance. Just a buddy. But that ain't no financial literacy right there. That's not me doing my due diligence. When you go buy a car, you should be doing your due diligence before you even show up on the lot. You already know what you want. You should already know the features and all of that stuff. That's called doing your due diligence. You got to do the same thing with your insurance. Who owns the insurance company? I bet you some of you probably didn't know this. There are mutual companies and there are stock companies. This tells us who owns the insurance company. If it is a mutual company, that insurance company is owned by the policy holders. If it is a stock company, that company is owned by shareholders. Now, why is this important? Because ownership affects how profits are used and whose interests come first. So if it is a stock company, you got shareholders who might not even have an insurance policy with that company. I'm just an investor. And if I'm an investor, I want to make the most for my money. I'm going to take more risk. I'm going to do whatever because I am an investor. So I don't necessarily care about what going on with little Joe. Joe passed away and it took 10 days before he got his money and this. I want to know, bottom line, what is my return on my investment? So stock companies tend to be a little bit more riskier. A mutual company is owned by the policy holders. What does that mean? These are people who actually have policies with that insurance company. So if I'm a policy holder with this insurance company, I'm trying to make sure that they got the best benefits for the policyholder because I happen to be one. Do you know if your insurance company is a mutual company or a stock company? I know I didn't. I didn't know. I don't know, right? But I should. Is there some state protection? So every state has like a association that will guarantee your insurance company up to a certain amount. It's almost like when you go and put your money in the bank and you know the bank has the FDIC insurance. Well, every state has protection that exists for an insurance company. I call it a backup system to protect policyholders. Because somebody gonna give me, well, I'm dead. I'm dead at that point. I didn't pay $400 a month for the last 40 years, and I die, and now the insurance company talking about they going out of business. They belly up. Somebody gonna pay me. My kid, somebody gonna pay, right? And so every insurance company should be registered with the association in that state. You need to find out what's the minimum because you may have a $1 million policy, but they only cover up to 500,000. You need to know that. Okay. Do they pay their claims on time? What's their claim history? Are there anybody that's complaining about issues? What's the customer experience? Yeah, yeah. It's more than just inviting the insurance guy over to the house to sit at the kitchen table. There's more to it than that. And I know I got some insurance people on, but y'all know this is true. There's more to it than just bringing the guy over or the girl over to sit at the kitchen table. Now, that's insurance, right? There's some other things that you should check out with insurance, but these are some of the big ones. Okay. And I got to speed up because let me see what time is it? What time is it? What time is it? We already at 9:30. I'm supposed to be done by now. I got to speed up. All right. So let's get into this IUL. Here's what an IUL is. It is permanent life insurance. That means that it has lifelong coverage. It builds cash value inside of the policy. That means that you are buying more than insurance. You are buying insurance and you are buying quote unquote a investment plan. It is linked to a market index and it participates in that growth. Many IULs are linked or tagged to the S&P 500. Now, for the average person, what you heard me say is that you get you an IUL and they're investing your money into the S&P 500. And that is not what happens. In fact, your IUL is not invested in the index. You will read the brochures. And when you read the brochures, you will see that it will say tied to S&P 500 index or tied to whatever index, or we follow this index. Now, to a layperson, you don't know no better. You saw tied to the S&P 500 and your mind and your brain automatically said, "Oh, they put my money in the S&P 500." That is not what they do. Tied to the S&P 500 does not mean in the S&P 500. And you need to understand that. And if I'm lying, you ask your insurance agent. If I'm lying, you go look at your policy. It is not investing in the S&P 500. It is tied to the returns of the S&P 500. Now, I don't have time tonight, but a portion of your investments will go to bond funds and some other things that's a lot safer. And then they will take a portion of it and invest it in options. That's right. They will invest in options. Okay. They will invest in options. All right. An IUL is designed to grow, protect, and provide all in one product. All right. Now, how does it work? Flexibility is a feature, but only if you understand the fine print. So if you buy whole life insurance gives you fixed premiums. They are predictable and they have a consistent cost. Now, with a whole life, you still have the cash value feature tied to it. Okay. But with a whole life, normally you have a fixed premium. With an IUL, one of the things that they sell is you get flexible premiums. That means your premiums can change. You can, you're spending $500 this year. You can, man, I need to cut back a little bit, maybe $400 the next year. You got some flexibility there. But that flexibility can cost you over time. Also, the flexible premium can increase over time and will probably increase over time because as you get older, the premium is going to increase over time. It is not going to be a fixed premium like you might find with a whole life. Definitely with the term life, it is going to increase over time. Okay. Because you're getting older. And that just makes sense. It makes sense. As you get older, if you have not died yet, the insurance company says, wait, we're taking on more risk because you're getting older. Okay. Now, permanent life insurance. This is something that I heard my father say recently. He said, hey, I got permanent life insurance. I don't have to pay for it. The policy's good. It's good until I die. That's what my dad said. He got permanent life insurance policy. How do you think the permanent life insurance policy takes care of itself if my dad does not have to pay anything on the insurance? Because see, I know my dad, and nothing against our parents or whatever. But I know my dad ain't did no research like I'm doing. But somebody sold him a policy probably 20, 30 years ago. And when he got to a certain age, they said, you know what? You ain't got to pay another dime on this policy. And he thought that was a good thing. I got insurance and I ain't got to pay nothing else on it for the rest of my life. Where do you think the money's coming from? Somebody type it in the chat. How is the policy being paid for? And my dad is happy because he ain't got to pay for an insurance policy. Somebody said cash value. Boom, cash value. Thank you. That's exactly where it's coming from. Ain't no insurance company giving you no free insurance. Remember, you built up the cash value over the last 20, 30 years. So he might have 30, $40,000 sitting in his cash value account in this permanent, y'all see me with the air quotes, in this permanent life insurance policy. And his agent has told him, you got a permanent life insurance policy. You're good for the rest of your life. You ain't got to worry about it. Once you reach this certain age, you can stop paying on it and the policy will still continue. But what they did not tell him, or he did not understand, is that the cash value that you built up inside of this policy is what's going to pay your insurance. And so while you don't have to come out of pocket, that cash, remember I sold you on the cash value? I told you you could build up your cash and you can borrow from it. And I told you all these sweet little things that salespeople tell you. And then on the back end, I told you when you reach this age, you don't have to pay for it because it pays for itself. But I forgot to tell you, I didn't lie to you, but I just didn't tell you that when it starts paying for itself, it's coming out of your cash value. And see, that's what I talk about when I talk about you got to be careful when you buying stuff from people that's selling you things. Even a financial advisor, even a insurance agent. I ain't saying that there's nothing wrong with the two, but what I'm saying is that if you don't have the knowledge, you will find yourself buying something that you don't understand and think you got something good. And this is why financial literacy is important. This is why being on the Sunday night call is important because I'm going to dig. I'm going to dig deeper than most people are going to dig. I'm going to break down all of this stuff more than what most people will do. Now, guess what? I'm glad my father has a life insurance policy. And you know what? He happy that he ain't got to pay on this life insurance policy, and he cool. And guess what? I'm cool too. Because at least he got life insurance. It's somebody daddy out there that ain't got no life insurance. At least mine got some. So the insurance agent that sold it to him, he wasn't a big bad wolf. He was just a bad wolf. The big bad wolf will really get you. At least my father has some life insurance. Everybody understand what I'm saying? And at this point in time, it's okay. What's done is done. He got some life insurance. He gonna be all right. He gonna be covered. He happy. As long as he happy, I'm happy. I ain't going in there, Daddy. They just slick willied you. No, I'm not doing that. But what I'm telling you on the Sunday night call is I'm telling you how to avoid getting slicked. You need an insurance agent, but you need to sit down and have your notes and ask the right questions so they don't put you in some crap or they try to sell you something and make it sound like it's so great, but then they don't tell you the back end of the other things. See, ain't nothing wrong with permanent life insurance and you not having to pay just as long as you know where the payment is coming from. It ain't free. And maybe the insurance agent told him, but he didn't understand. And he just think it's free. Let's keep going. Also, your insurance policy can become underfunded. June, what does that mean? Here's what it means. If my father lives a long time, which I think he's gonna live a long time, my dad is still cutting trees. My dad is still cutting trees with chainsaws and trying to climb a tree and cut some limbs, and I had to get on him. He still think he's 40 years old. He still operate like he's 40 years old. So I think my dad's gonna live a long time. But if he ends up living a long time, the older he gets, the more that insurance policy is gonna cost. And they're gonna take money out of that cash value. Keep taking money out of that cash value. What happens when the cash value goes to zero and he's still alive? It becomes underfunded, and then he loses the life insurance. Why did he lose the life insurance? Because he lived a long life. I bet they didn't tell him that. Because they probably said, well, black man, his average life expectancy is about 70, 72. Well, dad already beat him by 4 years so far. Some people just live a long life. So if he lives a long life, that permanent insurance policy might lapse because he didn't understand. Okay? I'm just keeping it real. Now, let's talk about why people like the IUL. And I apologize for going over, but I hope you guys are finding value here. For those who fund the IUL properly, and I want to underline who fund it properly, an IUL can serve multiple financial goals. One, they're going to sell you on downside protection. You'll probably hear this. It has a 0% floor because remember, they are tracking, they're not in it, they are tracking the S&P 500. Well, does the S&P 500 ever go negative? Absolutely it does. There's some years it goes negative. So what they tell you is you're never going to lose any money because it has a 0% floor. So you're never going to lose money. And that's a lie. That's a lie. So if the stock market goes negative and you get 0% floor downside protection, in your mind, you ain't lost no money. But guess what, y'all? They still charging you fees. They are still, that year that you got 0%, they still charge you fees that year. So you did lose some money that year. That's upside potential. They will tell you that it will track the index. But what they don't tell you, and maybe I'm jumping ahead. Let me slow down. I don't want to jump ahead. So they'll tell you you got upside potential because we're tracking the S&P 500. They will tell you that you have access to your cash value. You're building cash value. And then you can take a loan against your money. You ever hear these slick internet guys talking about become your own bank? Anybody heard that? You got these 20-year-olds, 30-year-olds telling you can become your own bank. Like they know what they're talking about. I'm going to tell you how you become your own bank, right? Then they talk about lifetime coverage. That's what my dad got, right? He got that lifetime coverage. He ain't got no IUL, but he got that life coverage. And then they talk about these tax advantage loans. So all of that sounds good. All of that sounds good. Here's what they don't tell you. They typically got high fees. They have a complex structure, which makes it very difficult for you to evaluate. And I'm gonna share some things with you here because I don't think I put it on the slide here. It requires strong funding, and your costs will increase with age. Okay. So why the IUL? Okay. Let me go back here. Let me see if I got in my slides here. Boom. So here's what you need to understand. The IUL says that we have a cap of 9%. So we're going to track the S&P 500. But if the S&P 500 has a great year and does 25% that year, you only get 9% because your cap is at 9%. Okay? That's the maximum return that they're going to allow you for that year is 9%. But if the S&P 500 goes to 25-30% that year, you miss out on all that upward momentum. Okay? But somebody's saying, well, at least I got 9%. Well, are you sure? Because they probably got this thing in your contract that says participation rate or spread. Well, what does that mean? Well, the participation rate is the percentage of the index gained credit to your policy. So if you have an 80% participation rate and your cap is 9% and the stock market did 12, you're going to get 80% of 9%. So you're not going to get the full 9%. That's called a participation rate. Or if they got a spread, there are fees that subtract from your gross gains. So instead of that 9% cap, you might end up with 7%. But see, when you read your contract, you had no idea what a participation rate even meant. You had no idea what a spread meant. But I'm here to tell you that there's good news because they have made this tool called ChatGPT, right? And so now let's go to ChatGPT. What is a participation rate in insurance? All right. Because see, a participation rate, that sounds like a good thing, right? Participation always sounds positive. Not here. Let's see what chat says about a participation rate. So I'm going to read it to you. A participation rate shows how much of a market's gain your insurance policy actually gets credited with. It is most commonly used in policies like IULs. Here's a fifth grade description. If the market goes up, you do not get all the gain. You get a percentage of the gain. That percentage equals participation rate. See, they never told me when they was trying to sell me an IUL and they said, don't worry, June, you get a 10% cap. Okay, they told me the cap, but they didn't tell me the participation rate. So it gave me an example here. It says the S&P 500 goes up 10%. Your policy participation rate is 70%. You get credit 7%, not the full 10%. Now ain't that a B? I'm gonna keep it clean tonight, but ain't that a trick? Why insurance companies use it? Because they are here to protect themselves. And here's what you need to understand. If I'm selling you something, I gotta make money. Now I might let you make a little bit of money, but I'm gonna make the bulk of it. You got to understand that insurance company is a business. Insurance is a business. They are not out here just because. They ain't trying to lose. Insurance company ain't gonna try to lose. It's like you going to the casino. The casino is built so that the house wins most of the time. So we got the participation rate. So then they start talking about these other things. The cap rate, this is the maximum that you can earn. We already talked about that. Then we got the spread. Well, what is the spread? And then it says real talk. This is where people get confused. Agents often say you're linked to the market. You see how they use these terms, but you're not invested in the market. They using words. They're using word tricks on you. So I said, okay, we got a participation rate. Well, what's the spread? Well, guess what? We got Chat GPT. What is a spread in insurance? See, ain't no insurance agent ever told me about the spread and participation rate. But then again, I never asked. You know why I didn't ask? Because I didn't know. So did they really lie to me? Not really. They just omitted. Let's talk about the spread. A spread in insurance is the portion of the market gain the insurance company keeps before crediting your policy. You'll often see this in policies like IULs. Simple definition: the market goes up, the insurance company takes a cut first. That sound like Uncle Sugarfoot. That sound like Uncle Sam. Then you get what's left over. The cut equals the spread. So, stock market goes to 10%, the policy has a spread of 3, you end up with 7. Now, why do they do that? Because they got to cover their costs. I already told you they're expensive. They got to manage their risk. They got to offer that downside protection. So, see, they tell you that you can't never lose because it's like you got a 0% floor. Well, how are they offering you a 0% floor? Because they got the spread. They're making the money on the spread. Y'all think I ain't making this stuff up, right? I'm not making it up. So the participation rate, they're getting that and the spread. The spread and the participation rate ain't the same. They are two different things. But we already saw that the participation rate takes from you. We saw that the spread takes from you. We saw that you capped. If the stock market does 30% that year, you still capped at 9. Well, June, why would somebody do this? Why would somebody even get an IUL? Well, you hear the smart internet marketers out there on TikTok and Instagram and everywhere else. They say because this is what the wealthy use. The wealthy use IULs. The question that you got to ask yourself is, am I wealthy? If you're not making $150,000 a year, you are probably not considered wealthy. Remember, every product is needed, but is needed for a specific person. So, and I done jumped around on my slides here, but I'm gonna try to hurry up. I'm gonna try to hurry up. I want to tell you why wealthy people use it. I'm gonna tell you why they use it. Let me just I apologize because I jumped around. I jumped around. I'm gonna tell you why they use it. Here's why wealthy people use it. Let me pull up. I'm gonna pull up my notes that I prepared for the slide tonight. But I'm gonna tell you why they use it. Um, Here's my notes down here. And these are all the things you want to check. We want to check their ratings, the track record, the type of insurance company, the state guarantee, all of that good stuff. All right. Here's why. This is the number one reason why wealthy people use this, because they can overfund the policy and then borrow money tax free. So, what is overfunding the policy? Let me go over here to ChatGPT because they're going to explain it better to you than me. And I want to make sure that you understand how to do this research. What is overfunding a IUL and why is it so important? Okay. Let's see what chat says. So, what is overfunding? So, overfunding a policy means you're putting in more money than the minimum required premium. So, maybe you got a premium of $300, but you decide to pay $1,000 a month instead of three. The goal is to build cash value, not just buying insurance. Now, when you overfund the policy and you put $1,000 in instead of the $300 that they were requiring, so you're overfunding, that means that that $700 is going towards cash value. So now you're building your cash value inside of a life insurance product that is tracking the S&P 500. Not in the S&P 500, but it's tracking. It is getting some good gains, okay? And then you can go borrow against that and pay no taxes. So it is a tax strategy for the wealthy. Instead of paying just the insurance, you add extra money on top so your policy can grow like an account. Example, required premium $300 a month, but you pay $800. That's $500 that you overfunded. It goes towards the cash value growth. Why is it so important? Because you can build your cash value faster and that money can compound over time. If you overfund, you can accelerate the growth. It reduces IULs have fees and the cost of insurance. If you only pay the minimum, most of your money gets eaten by the cost early. So what does that mean? That means the first 5 to 10 years, you ain't really building a big cash value policy because most of your money is going to the insurance company. It is only till later, if you hold on to that thing long enough, that you start building your cash value. But wealthy people don't care about that because I need to max out and put my money somewhere where it can grow tax free. The 401k will only let me do $26,000. I need to go put away $100,000, $200,000 a year tax free. My 401k won't let me do but 26,000. So I got to find another vehicle that I can put money into to grow tax free. And guess what? I ain't never going to pay taxes on it because I'm going to borrow against the cash value, quote unquote, become the bank now. This is where they get this become the bank. I am now going to borrow my money that I'm allowing to grow. It's invested, it's tracking the S&P 500. I'm allowing it to grow and I'm overfunding it. I'm putting more than what they asked. So that all the money that I put more in is almost like a savings account that's tax free, that's tracking the S&P 500. And then I can go withdraw my money, not get to cash it out, but get a loan. Because if I get a loan, I ain't got to pay no taxes on it. Right? So now here's the thing. They used to do that and they had no limits on it back in the day. And people started realizing that these wealthy people are putting $1 million extra in their insurance account. So they had to come up with a policy called the Modified Endowment Contract, the MEC. And it says, hey, there's only so much that you can put in above what you're supposed to pay. There's only so much overfunding that you can do. So now wealthy people are looking for the right policy that allows them to put the maximum amount of MEC that they can. I'm not going to do a search on the modified endowment contract, but you can go do it. So let's get back to the slide here. And here's the problem with Joe. Here's the problem with Joe. Joe making $70,000 a year. Joe just Joe is just able to pay his bills. And now you want to put him into an insurance policy that's very expensive. He is not building cash value until maybe 10 years later. Joe is on a $70,000 salary. He got tight cash flow. Most of us on this call got tight cash flow. Even your boy, from time to time, my cash flow get a little funny. So I have little margin for consistent payments. I got an insurance product that I'm supposed to pay 300, but I'm sending them 1,000. Well, who do you know in middle class America that's doing that? We're talking about real people in middle class America. You know that the average salary in middle class America ain't $100,000. So now I'm not funding this on a consistent basis. And then as soon as an emergency happened, I got to interrupt the plan because IULs was not built for middle class America. Let's take a look real quick and then I'm going to close the call out. How much is the average salary? Ah, didn't mean to do that. How much is the average salary for the middle class? Let's see what we got. The middle class range roughly between 50 and 150,000. Okay. Salary you need to be considered middle class, somewhere between 66 and $199,000. Let me just let me see. What percentage of Americans earn over 100K? Only 18% of Americans earn over 100K. Only 18%. So the majority of Americans are not even making 100,000. Housing cost is outrageous. Food cost is outrageous. You paying $20 a gallon for gas, you know, and you want me to get an IUL. I'm gonna just drop the mic right there. This is the reason why I say an IUL is not for the average person. Now, if you're in the insurance business and you want to argue with me on that, I'm gonna give you my email, send me some talking points. I'll review the talking points. And if I stand corrected on anything that I said tonight, I will come back next week and I will address it. But this is what I feel. And this is why I say that when you are dealing with anybody that's selling you something, if I'm selling you a car, if I'm selling you a house, if I'm selling you some insurance, if I'm selling you some financial services, whatever somebody is selling you, you need to have some knowledge. Because if you ain't got no knowledge, you don't stand a chance to get in a good deal. You don't stand a chance. You're going to get taken advantage of every time because you don't understand anything. You got to get financial literacy. And there's no excuse for anybody because you can do exactly the reason I went to ChatGPT tonight is so that you could see that you can do this too. You can find out the information. If you already have an insurance policy, upload that policy to ChatGPT and start talking to ChatGPT and ask ChatGPT some questions. I ain't saying the IUL ain't a good plan. Because if I was a guy that's making $1 million a year, I got a lot of disposable income. But I don't make $1 million a year. I ain't to the point yet. Lord, I said yet. Lord willing. I ain't at the point yet. that I got that kind of disposable income that I'm going to overfund my insurance policy. You see, that's why I tell you that if you're not maxing out your 401k, what you looking at an IUL for? I hope everybody understand that. You got caught up in you can borrow your own money, but your cash you ain't built up no cash value in it. So what you gonna borrow? See, salespeople have sound bites, and I can tell you that because I've been a salesperson. They got sound bites that they use. This sounds good. And if it sounds good and you don't know any better, then you're going to bite on that sound bite. But once you understand and you really start digging in and start asking the right questions, there will be cases where you will find that the insurance agent don't even know what they're talking about. The financial advisor doesn't know what they're talking about. Why? Because they've been trained to sell their company's product. They've been trained to sell the company's product. And they do it very well because the average person has no clue about what they're talking about. So the average person has to trust them because they sound good, because they wear a nice suit and a tie, because they got a desk, because they got some business cards. You don't need a degree to do what I teach every Sunday night. I ain't charging you a dime for this. So I ain't trying to rip you off on nothing. Every Sunday, you come here for free for the last 10 years. I'm here to give it to you straight, but only if you will take the time to learn. Because if you don't want to learn it, then you're going to get taken advantage every single time. Prayerfully, maybe you hook up with somebody that's going to do you right. But they got an office policy. How many sales did you get this week? How many sales did you get this month? I got a quota. And listen, ladies and gentlemen, if you ever worked in a job where you got a quota, man, that's tough. You might let a few slide. You might not reveal everything. You under quota. That's why you got to know. You got to know. All right, ladies and gentlemen, that's all I got for you tonight. I went over, but I hope that this was valuable to you. We're going to stop here. And I'm going to take some Q&A. If you are tired and ready to get off and it is 10 o'clock, I understand, but I'm never going to let you get off the call without you asking your questions. If you have questions, go ahead and raise your hand. If you got some questions here, I am looking in the chat to see if there are any hands that are raised. Miss Shirley Harper, Miss Shirley, go ahead, unmute yourself. We're listening.